I wanted to make this series about investing because I feel like there's a lot of young people out there that want to invest and they want to make their money grow, but they don't know where to start. There are a lot of different terms out there, a lot of different choices of what you can invest in, and it just gets overwhelming. If that's you, keep on watching. I want to make it as easy as possible for you guys. Hi and welcome to my channel. My name is Rebecca and I make videos about making your finances and your life more simple. This video is part of the Investing Basics series that I will link right here and down below in the description. I have a master's degree in finance, accounting, and taxation, and I have read and researched a lot on the topic of personal finance. I'm not an expert on all levels, but I will share with you what I know and we will learn more together along the way. If you would like to learn more about investing and managing your money, feel free to subscribe to my channel. In this series, we're going to talk about the very basics of investing. Today, we'll talk about the goals of investing and why you should invest. In the coming videos, we will talk about the different options that are out there, and I'll take you along with me and we'll buy a stock together so you'll learn about the process. I feel like this intro was very long, but it was the intro to the entire series, but now let's get started. So, what are the goals of investing? Obviously, number one would be to make money. We all want that. You want to increase your money and create wealth. That's why people invest. Another reason to invest is because you want to learn about the stock market, everything that's going on with investing. You can only learn so much by reading. If you understand how everything works, you get better at investing and you'll make more money. The third reason is to escape the effects of inflation. Inflation simply means that a product gets more expensive over time. Let's say you got $100 for your birthday 10 years ago and you saved it in your bank account. Because we have a high rate of inflation, that means that 10 years ago you could have bought more with the $100 than today. If you, however, invest your money will grow over time. So as prices increase, you don't have to worry as much because your money also increases. That's why it's absolutely necessary to invest your money and not just have it sitting in your bank account. The next and one of the biggest reasons to invest is compound interest. An interest rate is an annual percentage of the amount of money that you either lend or borrow. So if you take out a loan, you will have to pay the interest rate to the bank each year. If you invest your money, let's say in a bond, they will pay you the interest each year. Okay, let's do an example. Let's say you have 1,000 euros that you invest. Let's keep that number small to keep it more realistic. The average interest rate in the stock market for the past 20 years has been 7%. So let's calculate with an annual return of 7%. After 1 year, you will receive 70 euros as interest on your 1,000 euros. If you leave that 70 euros in the stock market, that means for the second year, you will receive interest not only on the 1,000 euros originally invested, but also on the 70 euros. So you will receive interest on 1,070 euros, and at the end of year 2, you will have 1,144 euros. That is compound interest. It means that if you keep your money in the stock market and also the interest, you will receive more and more interest over time. The longer you have your money invested and the more you can accumulate in interest, the more money you will make. Let's take a look what I mean here. So if you have the 1,000 euros invested and you don't touch it for 20 years, with the compound interest effect, at the end of the 20-year period, your money will have grown to 3,869 euros. So your money has more than tripled in size. Let's say you keep it in there another 10 years. So after
30 years, your initial 1,000 euros will have grown to around 7,600 euros.
That's almost double of what you got after 20 years. They say with compound interest, time is your best friend. Because the more time you have, the more your money will grow. Let's take it one step further and say
you keep the 1,000 euros in there 40 years. After 40 years, you will have 14,974 euros.
Why is the amount so much bigger than after 20 years? It's because if you decide to leave your money invested in year 20 and not take it out, in that year, you will get an interest rate paid of 270 euros. Compare that to the 70 euros you received in the first year. And with each year, the amount that you get keeps increasing. So the longer you can accumulate interest, the more money you'll have in the end. If you had kept the money in your bank account after 40 years, you would still have around 1,000 euros with the interest rate banks give at the moment. Okay, just because I love these numbers so much, let's go one step further. Bear with me. Let's say that on top of the 1,000 euros you invested initially, you managed to save and invest 100 euros each month. Just 100. After 20 years, you will not have 3,900 euros, but around 53,000 euros. And after 30 years, this will have increased to 120,965 euros. Would you have ever thought that 1,000 euros and then just 100 each month would lead to over 120,000 after 30 years? That's why it's so important to start as early as possible. Because if you have even a little amount of money and you can invest it, with compound interest and over time it will grow so much that you will feel sorry for not having started investing earlier. And don't worry, you can start investing in something that doesn't require a lot of knowledge, like an index fund, and you can learn more along the way. Nobody knows everything in the beginning, it's just important to get started. Okay, one more thing I want to touch on in this video is the difference of investing and trading. I feel like sometimes when we think about investing, we have the concept of trading in our minds, and that makes it seem so much more complicated than it actually is. Let's look at the differences. You probably know that the market goes up and down over time, which means that the prices for things, for stocks, will change over time. As a trader, you try to buy things as cheap as possible at a low price and then later sell it for a higher price. That's how they make money. They take advantage of the volatility of the market. The problem with that is that nobody knows and nobody can predict whether the market will go up or down. Even traders can't predict that. But what makes it a little bit easier for traders is they are usually professionals. They do this as their job. They get paid for it. They have a lot of equipment to help them analyze things. They have a lot of data to refer to. And that means they have the time and the resources that we as private investors don't have. It makes it a little bit easier for them, and some of them, not all of them, make money with it. Trading is also a very short-term thing. They typically don't keep their investments very long. Maybe you've heard of the term day trading. That means that the traders buy and sell a lot throughout the day. Traders take advantage of a small price change over a small period of time. As you can see, trading is a very active kind of investing. You have to be on top of everything that's happening. You have to know the news. You have to have a lot of time to look into everything, and you have to know when prices are changing. That's what also makes it very stressful. On this channel, I will never encourage you to trade. We'll talk about investing on this channel. You can never predict the market. You won't know whether the stock prices will go up or down tomorrow. That's why to me, trading is a bit like gambling, because you gamble on a specific price or a direction that you think the market is going to go to. So trading requires a lot of knowledge, time, and stress. So what we usually refer to when we talk about investing is this kind of investing, the more passive approach. This is investing for the long run. When you invest for the long run, you don't have to worry about short-term ups or downs of the market. You take advantage of the fact that in the long run, market has always gone up. As you can see, there have been some dips over the decades, but in the long run, the market has gone back up. Many times, investors choose monthly contributions, which means they save a certain amount each month and don't have to worry about whether the price is high or low at the moment. Then you just let your money sit and let the market do the rest. If you invest passively, you don't have to worry about every single trend and change in the market. You don't have to read the news daily and know everything. With investing, you don't have to time the market. You don't have to find the perfect moment to buy something. And overall, it's a lot less risky and stressful than trading. Okay, a very important thing to do when you want to reduce the risk of your investments is to be diversified. Let's say you only have stocks in the publishing industry. If everyone only read things electronically now or stopped reading altogether, that industry would go extinct and your stocks would be worthless. If, on the other hand, you had only stocks from one certain country, that would get you in trouble if this country gets economical problems or a war started. These events cause stocks to go down and lose in value, so you would lose money. So that's the reason why you should have high diversification in your investments. You can achieve that by either choosing a diversified index fund or buying many different stocks from different regions, different company sizes, and different industry sectors. We can talk more about how you can achieve diversification in another video, but for now it's just important that you understand that diversification is key. So usually they recommend that an investor sit down every year once or twice to reconsider your strategy, look at your investments, look at the diversification, and then readjust accordingly. So that's the time and effort that would be required for you to be an investor. But don't stress about overanalyzing and having the perfect strategy in place right now. Let's be real, in the beginning it's so much more important to get started and take advantage of compound interest. Investing might sound complicated at the beginning, but in reality, it's not that hard. When you're new to this topic, the most important thing is to just get started. So don't overanalyze, over-prepare, overthink everything, because time is your best friend. Just get started and then you can do the fine-tuning later on. That's exactly what I did, and I can recommend this approach to you. So that's it for this video. Thank you so much for watching. I hope you liked it. Give me a thumbs up if you did. And if you're ready to learn more about investing, just watch the next video in the playlist. I will keep adding more videos as I upload them. And let me know in the comments down below what you would like to see on my channel next.